Good morning and thank you very much for joining us today. My name is Nick Boogerin and I'm part of the AMP Investments team. Today we'll be going through the latest on all things investments with the AMP Economics team, but a few housekeeping items to start. I just wanted to let you know that there will be CPD points available for today's session, and in order to be eligible you need to attend the majority of the live session. Also, the session today will be recorded and the recording will be distributed to all registrants post this event, so please keep an eye out for that. And finally, we will have a Q&A session at the end. So if you have any questions, there is an area at the top right of your screen where you can submit them and I'll put them to the panelists at the end. Now, at AMP Investments, there's actually been some really exciting changes and developments that the team have been bringing investors. You may have seen in the financial press, but AMP was Australia's first super fund to include Bitcoin in our fund, which has been really well received. We're now working on additional developments in this space, so please keep an eye out for that. AMP is also launching its Constructor series, which is a program where we're taking our institutional-only building blocks that we use for our internal portfolio construction and now making them available as standalone options for advisors to utilise in their portfolios. The first that's now available is our South Peak building block, which provides a really interesting point of difference for portfolios that has a low correlation to both equity and bond markets. So please reach out to the team if you wanted to see a little bit more about this one. But having said all this, there is one thing that certainly isn't changing, and that's our economics team. And today we have our Chief and Deputy Chief Economists, Shane Oliver and Diana Mousina, and they will take you through today's session. So I'll now hand it over. So Shane, over to you.
Okay, thanks, Nick. Diana will be back in a moment, so we'll share the slides, the presentation, and of course the Q&A at the end. There might be a little bit of lag in getting the charts up, but I think one of the things we've noticed in the last 6 months is the volatility associated with tariffs in particular. But despite all of that, maybe I should have mentioned the disclaimer there, the old line that if you think I'm here, you're really imagining things. Not quite. But anyway, that's what markets have done, major share markets there. You can see that big dip going into the April low, so record highs in February for most markets, global shares, Australian shares, fantastic. Everyone celebrating Donald Trump's victory and other things and surviving high inflation and central bank rate cuts. Then we had that big dip starting in particularly through March going into April. US shares down about 19%. We were down about 14%, other markets somewhere in between. And then, of course, rebound to record highs. Of course, these charts were put together, finalised a few days ago, but we have gone to record highs in Australia and the US. A little bit off it, but not much. And Europe's close to it, but not quite there yet. But when you look at global indices, they are at record highs. Been a bit of a mixed bag in some of the other asset classes. Diana wrote a fantastic note last week on the US dollar from king dollar to pauper dollar, and the US dollar has in fact had its weakest start to the year since Nixon was president way back in 1973, I think it was. But other things have done reasonably well. Share markets have done pretty well. The Aussie dollars perhaps had a bit of a roller coaster ride, but doing relatively well. And gold has gone to record highs. And of course, Bitcoin's done fantastically well. Obviously, get volatility in those asset classes. But the tariffs seem to have been ingested by markets and adjusted, but obviously that's still going to be a source of volatility. I think the key is that if you look at the last 12 months, it's been a fantastic period again for investors. Typical balance fund returned about 9% over the years 22-23 and 23-24, and over the last financial year, on our estimates, returned 10% or a bit more. Some of the AMP funds did better than that, but still, we saw reasonably good returns for balance funds. We're just trying to get the charts moving here. Hopefully that will move soon. But in any case, despite that volatility, and you can see it there, despite that volatility, it's been a pretty good period for investors. 3 years of 9% plus. Last rough period was in 21-22, which was the time of high inflation. back then. And you can see most major asset classes doing reasonably well. The red bars are the previous financial year, the green bars are the latest financial year, and the 5-year average is shown in blue. And obviously growth assets doing pretty well. In a typical super fund, you can see they go up and down. I know we have shock horror every time they go down, but history, it's not that unusual. And so you could argue, well, we've had 3 great years, maybe we'll have a tougher time over the current financial year. Time will tell on that front. But I might just move on to the economic outlook as we see it. I mean, to cut to the chase, I reckon returns from a typical balanced fund will slow down. You know, you can't expect 10% forever. It means that PEs will rise to infinity if you go at that rate, given the rate of growth in economies and company profits on a sustained basis. So returns will slow down, but I'd say it's more around 6 to 7%, but you should allow for another bout of volatility. Key summary views, I think, is that tariffs will dampen global growth. We're about to see more on that. That's already ramping up again this week, with Trump talking last night about 200% on pharmaceuticals, 50% on copper, and of course, reciprocal tariffs kicking in again on April the 1st. But I think global growth still remains positive. We avoid recession. We'll get central banks cutting interest rates. Aussie growth probably still a bit sluggish this year, around 1.6%. We saw the Reserve Bank forego a rate cut yesterday. We think they should have cut. We got that wrong. Our expectation was they would move. I guess you can always say we weren't exactly surprised. Occasionally they do things different to what you expect, but we thought there was a strong argument to cut. But we do think that they will be cutting again come August, November, and probably a couple more times early next year, getting the cash rate down to around 2.85%. Inflation, we think, will fall further. Share markets, as I mentioned, should allow for another correction, maybe in the seasonally weak months of August, September. Could be another 10-15%, but I reckon by year end, with central banks cutting, including the Fed and the RBA, markets will be up again, and that of course assumes we avoid recession. So a bunch of things to watch. Tariffs are high on the list, and on that note, I will hand over to Diana. Thank you.
Okay, thanks, Shane. So when we think about the impacts of how tariffs are impacting the global economy, we haven't really seen much negative indicators so far. I guess the only one has been that consumer inflation expectations in the US have gone to a very high level, basically the highest level that they've been at since the 70s, even higher than what they were during the pandemic, despite the fact that we do have much lower inflation. But other global growth indicators are actually holding up relatively well. So we look at the purchasing managers' indices as a forward-looking sign for growth, and those are still tracking along okay. We have seen a slowing in services indicators, but you sort of expected that after the strength that we had in the years after the pandemic. And manufacturing is still tracking basically at levels that have been unchanged in the past few years. So there's nothing really so far to be too worried about. Global growth still looks like it's running at around 3%, which is basically its long-term average, although of course there are pockets of differences. Weakness in the US is expected this year. We've downgraded our growth forecast, for example, from about 2.5% or 2.3% in the US now to about 1.7% or so for this year, and Europe's likely to do a bit better. Obviously, everything is sort of hinging on what's going on in the US and how that sets the global growth agenda. Some of these pictures, which I've snipped from Google, just demonstrate a few of the key things that economists have had to keep on top of. The first and foremost being tariffs, which are still ongoing. Of course, the changes in the government related to Elon Musk's Doge, although he's now left that department, apparently saving the government about $170 billion or so, although some say that that's too much, but much lower than some of the numbers that Doge initially was talking about. Their goal was to save the government around at least $1 trillion over the course of the 4-year cycle. But it seems hard to see that Doge impact lasting, given that Musk is no longer in charge and wants to make his own America First party to sort of account to the Democrats and the Republicans. And of course, there are a lot of other funny things that are going on, like the Trump mobile priced at $47.45 because Trump was the 47th and the 45th president. Trump coin, the relation to cryptocurrency and Bitcoin, and of course the Trump cologne, which is there on the top left. So lots of funny stuff to keep us entertained and give us plenty of content for our social media videos. So in terms of what's going on with tariffs, we call it a bit of a tariff roller coaster, which you can see in that left-hand chart. Basically, before Trump started, the average US tariff rate was running at around 3%, and that went to a high of around 35% or so on Liberation Day, which was its peak. And then there are a whole bunch of trade deals that have come after that, mainly the one that was done with China, exempting some smartphones and other electronics that are sort of key to US consumers, making a few trade deals with countries. A lot of those have been announced in the last week. Most of the deals look much better for the US than they do for the other countries. The other countries basically have to pay, the US basically has to pay a 0% tariff on any of the goods being exported into those countries, but a lot of those other nations have to pay tariff rates of 25, 30, even 40%. So we don't really know where the average US tariff rate is going to end up. I guess we don't know the exact point level, but I think what we do know is that it's not going to be as high as those post-Liberation Day levels. It's probably going to end up somewhere between 15 and 20%. Now that's still multiple times where it was before Trump 1.0, which does mean higher consumer inflation, at least in the short term. Tariffs will often have a bit of a level adjustment to prices. So prices will go up initially, and then hopefully you won't get as many level changes in prices. And it does mean lower growth, but we don't think it means a collapse in global trade growth, because there are deals that are being done, and we think countries will basically just have to adapt their trade channels to whatever is being set in the US. And you can already see countries trying to change some of the ways that they do business and potentially find new export markets as well. So for a small open economy like Australia, that may actually be positive in terms of some of the goods that we may receive from the rest of the world if they have less inflation compared to what we're used to if we get cheaper goods coming through. It's also important to keep in mind that consumers will change their behavior. So fundamentally, the point of the tariffs is that consumers will not choose imported goods, but will choose if there is an option, the domestically produced American goods. Now, it remains to be seen whether we do get more US manufacturing production that's based there, but that is the ultimate point of the tariff. So we do also track the effective US tariff rate, which is that chart on the right. And at the moment, that's sitting at about 9%. So it's moved up from 2.5% or 3% up to 9%, but of course not as high as those post-Liberation Day levels. So yes, tariff rates are high, but they're not at those extreme levels where you would sort of be worried about a complete collapse in global trade growth. And we know that Scott Bessent, the US Treasury Secretary, has said that they don't want it completely decoupled from China, basically because they can't, given that China is so important to the US economy. But nevertheless, all this tariff uncertainty is, of course, causing a lot of the downs in share markets that we saw after Liberation Day that Shane already went through. US trade policy uncertainty is at a record high, which you can see in that left-hand chart. And uncertainty isn't good for businesses, and it's not really good for consumers either, if consumers expect that the cost of their goods is going to go up significantly. If you do a calculation about the average price of an iPhone, for example, sort of the I guess a good signal of where consumer electronic prices are going to go with these tariffs. Pre-tariffs, you could get an iPhone 16 Pro in the US at about $1,100. With some of the tariff rates that were announced for specific countries, that level would probably go to about $1,200. And then if the US is serious about actually getting all production done domestically in the US, you're looking at a cost of about $2,500. So fundamentally, we don't think that US manufacturing is going to be completely based in the US, just because it's not possible given how high these prices are going to go. I think it's hard to actually imagine a world where everything is made in the US. I think that there will be some increases to robotics types of manufacturing, but it's hard to see all consumer goods being ultimately made in the US. So tariff revenue is going to go up from here, but probably not as high as where the government would have wanted it to go. If we just go to the next slide, please. And of course, the rest of the world is responding to what the US is saying, and as I said before, there's plenty of funny stuff that that we have a lot of laughs over in our team around what's happening in the US. But unfortunately, for most countries, given that the US is the largest economy in the world, or the second largest in purchasing power parity terms, there is not really that much leverage that they can pull. And you can already see that with some of the trade deals done, for example, with the UK and Vietnam. Most of the countries have gotten the shorter end of the deal, and that's probably going to be the case for a lot of other countries as well, including China. The China deal probably benefits the US more than the Chinese economy. Just go to the next slide, please. The other major policy change in the US is the One Big Beautiful Bill Act, which did get passed. So this includes the tax cuts which were meant to expire at the end of this year, the initial tax cuts that Trump brought in place when he was initially president. These are mainly tax cuts to middle and higher income households. There was also a bunch of stuff in there related to lower taxes around things like overtime and tips, lower state and local tax deductions as well. And there were some spending cuts in there as well, basically to help pay for some of the tax cuts that are going to occur. A lot of the press last week was related to the spending cuts on things like Medicaid and the SNAP, the food programs that were done there. But even despite those spending cuts, the actual bill will still keep the US budget deficit at a very high level. And in the short term, it will actually increase the budget deficit. Now, that is a problem. The budget deficit in the US is currently running at 6.5% of GDP, which you can see in that blue line on that left-hand chart. Federal gross government debt just continues to increase over time. And with the One Big Beautiful Bill Act, that budget deficit will reach about 7%, potentially even a bit higher. So unfortunately, the situation around US debt and very high level of debt relative to GDP is still going to dampen the US economy. The worry is not really so much can the US finance itself. The US can issue debt in its own currency. There's still a lot of demand from pension companies for US bonds, but it probably does mean that US bond yields stay high relative to the what they have been trading at over the past 10 years. The One Big Beautiful Bill Act will keep US bond yields probably at around 4.5% to 5% in the near term. And of course, it does mean higher interest payments that the government has to pay. And in times of a downturn or a shock, there will be less room for the government to act, given that they will be dampened by having such high levels of budget deficits and federal government debt. The customs duties that are coming from tariffs are one offset to that, to the One Big Beautiful Bill Act. They are not included in the Bill Act because they're not actually legislated. They're being done with what's called an executive order. So it's not actually legislated into law. But at the moment, the tariff revenues are running at about $300 billion on an annual basis. So it will provide some offset to the higher rates of spending that have been done on the bill. Where does China sit in all of this? Australia is obviously very sensitive to what happens in the Chinese economy, given our strong trade relationship with them, and they take about 35% of our exports, particularly for our commodities. I'd say that Chinese growth has probably been surprising a little bit to the upside recently, and we think that the Chinese growth numbers will be at around 4.5% or 5% this year, which isn't actually too bad. It is quite a mixed bag, though. There is a lot of weakness in the property market in terms of property investment, housing sales, property prices. So that is still a big form of weakness because a lot of consumers choose to save via the property market in China. There is no real superannuation or pension system there, so a lot of saving is done through housing. Retail sales probably a little bit softer than we'd like as well, but then other parts of the market like fixed asset investment and exports are doing quite well. And China has the ability to stimulate its economy as well because they don't have an inflation problem and there is more room to do fiscal support, particularly for consumers. It's just been a matter of the government not wanting to do what they call Western style fiscal support in terms of direct handouts to consumers. So our view is that China has the potential to get itself out of any potential downside because it does have the room via monetary or fiscal measures. And the signs of a recession, either for the US or for global growth, they are pretty low. The March quarter for the US economy was a negative, so that got people excited or concerned that the US was headed into a downturn. But a lot of that weakness was down to a big increase in imports. Imports are a drag on GDP growth. And a lot of the reason for the rise in imports was because people were trying to front load some of those tariffs. And we've seen a rebound in growth numbers for the second quarter. So it doesn't look like the US is headed into a downturn. I mentioned before our growth forecast for the US has slowed. We're now expecting 1.6 or 1.7% growth in 2025 for the US. Without the tariffs and some of the trade uncertainty, that would have been over 2%. So there is lower growth expected, but not recession type levels, which is good news for markets because we know that the worst times for markets are when there are recessions. And here's a picture of my favorite girl from the US. So this is the press secretary, Carolyn Levitt. Shane hates her. I think she's a sorority girl and talks rubbish, so we have a lot of funny debates in our team about this. But, this is quite entertaining to watch some of these White House press conferences. She's pulled out a letter that Trump wrote with his Sharpie to Jay Powell, the chairman of the US Federal Reserve, saying, "You're too late, Powell, as usual. You should be cutting interest rates by now because we don't have an inflation problem. We should have rates closer to 1.5% rather than the over 4% level that the US has at the moment." So how does the Fed respond in this environment? It is quite tough for them, given that there are these higher inflationary concerns coming from tariff risks. At the same time, if tariffs actually hurt consumer spending because you sort of have this inflation tax that's put onto consumers, that could be a negative for US growth. So the Fed is in a bit of a tough position at the moment. Our view is that we will see a few more rate cuts from the Federal Reserve, maybe another 3 or so in this cycle. But the Fed has already cut by 1%. Compare that to the RBA, that's cut by 0.5%. So the Fed's sort of well underway in its easing cycle. We think that US interest rates will probably end somewhere at around 3%. So that's sort of the neutral level of rates. We don't think that the US needs to have rates of 1 or 1.5%, like Trump says, because the labour market's still in good position. The unemployment rate has not really budged that much. It's sort of been this glacial rise in the unemployment rate in the past 12 months. It's been sitting at 4.1 or 4.2% for a long time. Some people say that there are signs of cracks in the labour market, but the unemployment rate hasn't really increased too much. So I don't think that there's this need for rates to be lowered too dramatically. Of course, Trump would like lower rates because lower rates mean that the US has to pay less on its interest costs. Oh, my slides keep moving around quickly. Let me just go back to the other one. I wanted to touch on how geopolitics impacts the economy. We've spoken about the political side of the US economy, but how does what's going on globally in geopolitics impact share markets? Well, there's been a lot of that recently, in particular with what happened with Israel and Iran and the escalation there. The point of this slide is basically just to say that you can't time geopolitics, that it's extremely difficult. Just like you can't time the share market worst days and the best days, knowing when an event is going to occur based on politics is basically impossible to time. Now, usually when we looked at historical major geopolitical events around the world, we saw about an 8% drawdown to the US S&P 500, and that could have occurred over the space of a few days, over a few months. It just depends on the nature of the event. But usually a year after, share markets were up by 14%. So most of the time, share markets do look through the uncertainty that's caused by geopolitics, even though at the time there does tend to be a big fall in shares. So we obviously take what goes on with geopolitics very seriously, because in the short term it can have implications for a drawdown, but timing it is really hard. And for long-term investors, it's better just to keep the long-term view in mind, and just to keep in mind that if you look at that right-hand chart, we call this shares climbing the wall of worry. You can see that despite all these different things that have popped up over time, share markets have still tended to rise over the long term. So geopolitics can impact you in the short term, but if you're a long-term investor, you just have to sort of ride out the cycles. And obviously there are different types of events as well, like the Russia-Ukraine war had a much longer impact to commodity prices, and that was a longer term impact to the European economy as well, and caused them to have a big dip in growth. So it also does depend on the nature of the conflict. Luckily, the Israel and Iranian conflict did end in a relatively short period of time. For other central banks around the world, we spoke about the Fed, mentioned the RBA. We do think that we are still in an easing cycle, and we should get some more rate cuts from the rest of the other major central banks. We've seen lower growth come through around the world, not at recessionary-like levels, but also higher unemployment rates, and that basically means that we do have to see the rate cuts from central banks to be ongoing, at least for the next 12 months. We're definitely not in a rate hiking cycle yet. Could we go to the next slide, please? Having a lot of trouble with my slides today. And inflation's not really a problem for the advanced or the Western world. And we obviously went through a period where inflation was running at 8% levels on a yearly basis, and now around the world most inflation rates are around 2.5% or so. And this chart looks at the interest rates that are set across the different major economies, and you can see that most have already started the process of cutting rates, and that should be ongoing until the beginning of next year, when rates are likely to be held steady. But it's hard to see any need for rate hikes at this stage, particularly as we live through a time of uncertainty. And inflation in parts of the world is still a little bit elevated, like in the UK, for example. They do still have some issues with services inflation. So there has been a lot of progress to get prices down, but there are still pockets of issues, particularly in the services space. Can we go to the next slide, please? Goods inflation went through this big fall after the pandemic, and we're not really seeing too much upwards pressure in goods prices. I guess that could be challenged by tariffs, particularly in the US. So goods inflation is likely to rise a little bit in the US. In the short term, by the end of this year, we think that headline CPI in the US will be running at about 3%. Prior to the tariffs, we thought that probably would have been around 2.5% or so. In Australia, we've made very good strides in reducing labour costs. So if you look at that right-hand chart, that's the NAB Business Survey indicator. You can see that purchase costs, labour costs, and final product prices have all come down quite significantly. So inflation pressures have well and truly abated, and now we're seeing that the RBA targets inflation of 2 to 3%, and inflation is well within that 2 to 3% band. So we should be seeing some more rate cuts. Shane mentioned at the beginning that we thought the RBA should have cut yesterday. I think that their decision was wrong, but I'm not on the board, so that's my problem to deal with, I guess. They basically said it was an issue of timing rather than direction. So they're basically telling us that they still expect to cut rates. They just want to wait for the full set of inflation figures, which we get at the end of this month. So our view remains that we will get 4 more rate cuts from here. Those will come in August, November, February, and May of next year. So 2 cuts next year, 2 cuts in the second half of this year. So with the cash rate ending at 2.85%, we think that the economy needs more support. And that's clear in the poor March quarter growth figures that we had. It's clear in the monthly inflation data. The labour force figures showed a fall in jobs growth in May, and the unemployment rate has slowly been creeping up. I mean, it's still at very low levels at 4.1%. It's still around the lowest levels that we've had in nearly 50 years, but it has creeped up a little bit. And the longer that you keep rates at a restrictive level, like they are in Australia, the higher the risk that the unemployment rate shoots up a lot further than the 4.4 or 4.5% that it's expected to reach. That's why we think that the RBA ultimately needs to be cutting interest rates. And we do have very low productivity growth in Australia. The March quarter GDP figures showed that we haven't really seen an increase in productivity growth since 2016. We had a bit of a short-term spike during the pandemic, but that was a bit of an aberration because of the way the data was measured and a big fall in hours worked. Now, rate cuts can't help to increase productivity growth, but they can help to get the economy moving, to get more certainty as well for businesses. But the decline in productivity growth is obviously a big problem. And you can see the huge step down in GDP growth that Australia has had in that left-hand chart. We're now experiencing this lowest rate of growth outside of the pandemic since the early 90s recession. So we're not really feeling like the lucky country at all at the moment. Which brings me to the next slide, and I'll hand over to Shane.
Okay, thanks, Diana. I got a shot from one of our videos there. Want to catch up on those? They're worth a watch. Anyway, we might move on to the next slides. Not sure if we're controlling it or someone else is. Productivity is going to be a bit of an issue in the month ahead. The government, thankfully, has announced a productivity summit. Kind of reminds me of the early days of Labor in the 80s with the summit. I think it's good to see the government has recognised the problem. How far they will actually go in addressing the issue remains to be seen, but at least we're going to have that discussion. The question is what we can do about it. One of the big issues, which we've talked about quite a lot in various notes and things, is that the tax system in Australia is a bit skew-with. We have a very high reliance on income tax, as you can see in that chart there. Something like 70% of tax revenue comes from income tax, 60% rather, whereas in many other countries, including the OECD average, it's well below that. They're far more reliant on the GST. And economists love things like the GST because they are economically neutral. You pay the same tax rate on everything. It doesn't distort economic activity. Whereas income tax on a corporate or an individual distorts economic activity, decisions to invest or decisions to work. So ideally, you should reduce that reliance on income tax in favour of the GST. It didn't really impress me that much. The Prime Minister said, almost ruled it out, that they would consider an increase in the GST on the grounds that it is regressive. It does certainly tax lower income earners more as a share of their income, but that can be addressed by raising the pension, raising welfare payments by the same amount as the estimated increase in the GST affects inflation, and also pushing out the tax scales to benefit low-income workers. So there are ways around that. I guess the question is, what else can be done? I think Australia is overly regulated. Whatever you do, there's some regulation around it these days. In Australia, we have become a bit of a nanny state, but that has the effect of making it harder for businesses to do things, whether it's manage their workforce or manage a lot of the activities they're trying to do. Even the government's latched onto this. It's taking twice as long to build a unit these days, almost twice as long to build units these days as it was a decade ago. And a lot of that down is due to regulation, which has shot up dramatically. Public spending, if we go on to the next slide, has gone through the roof in Australia. You can see the share of public spending at a record level. That has a problem because it distracts resources from the somewhat more productive private sector, and that makes the overall economy less productive. So yes, arguably, we do want those things that we've seen recently, the care economy, aged care, healthcare, the NDIS is a good thing. We've got to manage that properly, make sure that the system's not being rorted, but also make sure that we can do the very best we can in making savings elsewhere. If we're going to have those things, we've got to find savings elsewhere to keep the government sector down to a relatively low level. Healthcare system, you can do a lot of work in that, particularly in regards to prevention. Something like 70% of diseases these days are preventable. And, prevention can work there. I've talked about deregulation. Education system is not doing what it should do in Australia. So there's all sorts of issues we need to look at in terms of productivity. And hopefully something will come out of that at the Productivity Summit. There's recently been a lot of talk about the super tax, the $3 million super tax on balances in excess of $3 million. I mean, to me, that's a retrograde step. Diana did this chart months ago, and it's been widely quoted. It's a fantastic chart. Just shows that someone joining the workforce today, i.e. my son, on average wages, he just started earlier this year, on average wages, and average returns from his super fund, will find himself going above that threshold in his working life. And I should say, you could say those numbers are a little bit conservative, because we applied the 15% tax to the whole of the super fund return, which is almost on the unrealised gain as well. So you could argue the tax treatment in that little graph is perhaps a little bit over the top. So in other words, you might get there earlier. So that's an interesting debate. Maybe we should point this one out to some of those people who are rubbishing the chart. But that's a clear risk. What the government needs to do is make sure they're only taxing, I think, realised gains, and secondly, indexing it, or telling us at what point they will index it at. So obviously, I think that's a retrograde step. But the government to say, well, it doesn't matter, we have lots of other taxes which aren't indexed, I think is irrelevant. We don't want to follow bad policy after bad policy, as Bill Kelty pointed out recently. Moving on to the next slide, tariffs, getting into the newspapers again. Looks like we're going to stay at the 10% baseline on most products. We will face 50% on steel and aluminium. That's already there. And pharmaceuticals, you can see in that table there, pharmaceuticals are one of our biggest exports to the US, $2.1 billion last year, far bigger than steel and aluminium. And Trump overnight was talking about 200% tariff on imports into the US of pharmaceuticals. So it could be an issue there. But put it all in context, it's less than 5% of Australian goods exports. It's not a big share of our economy. The main threat, apart from the obvious negative impact on industries affected, the main threat for Australia is tariffs globally, adversely affecting global growth. And that's, I think, a concern of the Reserve Bank as well. So moving on to the next slide, different states, as always, performing differently. Top performing state in Australia right now has been WA, and that's been the case for a while. Bottom performing state, unfortunately, is Tasmania. Victoria is number 7. New South Wales is number 5, roughly in the middle of the pack, and Queensland number 4. So the big ones are in the middle of the pack, and WA still shooting the lights out. So I might move on to the next slide. This one here, we occasionally focus on this. My generation benefited from a long-term decline in interest rates as inflation came under control from the 70s and 80s. That's been great for asset markets. We saw an inflation surge going into 2022. Bond yield surged on the back of that. That's starting to come under control again. But it seems to me that long-term downtrend is probably over, which acts as a bit of a constraint on investment returns. If you're getting long-term decline in interest rates, that pushes up the value of assets. If they trend sideways, which I think is probably what's going to happen here, it's not as big a tailwind. It's no longer a tailwind for asset markets like property and shares. They can still generate good returns, maybe just not as much as they were through much of my career. Whole bunch of factors at work there: deglobalisation, more government intervention in economies, and so on. Adversely affecting economies and their performance, leading to higher interest rates. A risk that Deanna touched on there is that we get a public debt scare in the US, given their higher levels of public debt, resulting in higher bond yields in the US. Although I hope that bond investors globally will differentiate and say, well, the US is more at risk of that, Australia is less at risk, given that our public debt ratio is a fraction of what it is in the US. Just on terms of profits, we have seen a bit of a downgrade to profit expectations for this year. They're still running around 10% for the US for the next 12 months, that is. So you could argue that might still be a little bit optimistic, and you might still see some downgrades there. But so far, the US companies keep surprising on the upside. And we'll get a test of that in the next month or so with the current profit reporting season. Likewise, in Australia, we've been a lot weaker in Australia in recent times. Profits have been a lot softer. This year, the expectation is for growth of only 1%. I suspect there are some downside risks to that if growth comes on the soft side. Share markets may look through it, though, as long as interest rates are still going in a downwards direction. And as Deanna said, we do still expect the Fed to cut interest rates this year. The reason there's a bit of risk around share markets is this one: PEs are relatively high, bond yields are also relatively high. So when you look at an equity risk premium, that is the gap between the earnings yield on shares, the inverse of the PE, less the bond yield, it's around 0 in the US and only a little bit better in Australia. So Australia does stack up a little bit better on that front. Europe stacks up a lot better, and interestingly, China a lot better again. So at some point you'd say, well, these other markets will do better, I think. But valuation is certainly not a great guide to timing markets. I wouldn't recommend someone see this and say, well, I've got to sell shares now. It could be resolved over time if economies avoid recession, which they think they probably will, and bond yields stop going up and maybe come down a little bit. In the meantime, though, it does leave the markets open to corrections and bouts of volatility. And just interestingly, on the right-hand side there, we've shown a measure of sentiment. It had become quite positive earlier this year. It got very, very negative at the lows in April. Right now, it's around neutral. So it's not really telling us much in terms of where markets will go. If we move on to the next slide, which is right there, Australian housing, a bit like a broken record on this one. You keep saying the same things over and over. It seems I've been doing that for the last 20 years. Australian housing is very expensive on global comparisons. Yeah, sure, if you look at New York or LA, New York, I think San Francisco is also quite expensive. It's comparable, maybe London to Sydney and Melbourne, but the thing is America and Europe have lots of smaller cities where housing is quite affordable, and yet we don't have that. Bunch of issues there. We have a shortage of housing. Bottom right chart, we haven't been building enough homes to keep up with the demand for houses from population growth, so we've got to get that recalibrated, supply more homes, make sure we limit immigration levels to be in line with the ability to supply more homes. And I guess the other aspect is that's a positive. A negative, though, is that affordability is very poor. That'll keep a little bit of a cap. But if interest rates come down, I suspect that house prices will go up. So we're looking for house price gains this year of around 5 to 6%. Not fantastic, but still better than they have been. And of course, not fantastic at all if you're a first-time buyer trying to get in. You'd rather house prices don't go up at all. I would say, though, for all those who blame this on the RBA, I think that's complete nonsense. Yeah, sure, interest rates have come down and house prices have gone up over the last 30 years. But the main driver of that, the real problem, has been the lack of supply, the shortage of housing we have in Australia. The RBA has to set interest rates for the average of Australia, not just for the property market. If you want to get affordable housing, it's government down there in Canberra and in the States that really need to fix that up. So Aussie dollar, we reckon, is a little bit undervalued. Bottom right chart there, fair value we think is around 73 cents. It's about 65, so a bit of upside there as the US dollar comes down. As per Diana's note from last week, the US dollar is also overvalued. So over time, as the US dollar comes down, the Aussie dollar should go up. Beyond that, very near term, I think it's a bit of a messy outlook for the Aussie, but I do think on a 12-month basis, it probably goes higher. Moving on to the next slide, medium-term return potential. We reckon around 6.1%. You can see where we got the returns from there, from that little table. And that's probably as good a guide as any to what we'll get over the next 12 months. Like history tells us that to have a bear market, or at least a deep bear market that lasts more than 12 months, you can fall 20%. We almost fell 20% back in April in the US. But to have a sustained fall, a sustained bear market, you've probably got to have a recession. And we think we'll probably avoid that, albeit there will be worries about it, which can cause volatility and corrections. So our base case is 6%, maybe 7% return over the next 12 months. Final messages for investors before we hand back to Nick and take on questions. I love these charts. I love the wall of worry chart that Diana put up. One of my favourites. These ones are as well, particularly the one on the right there shows the Aussie share market back to 1900. You can see the rolling 12-month returns all over the place. Really hard to predict. I know people will say they predicted that shares would bottom back in April. They predicted that shares were going to peak in February. But I'm always a bit sceptical about that. And I often find that gurus who get it right, I'm thinking of Dr. Doom, a guy called Henry Kaufman back when I started my career, or Nouriel Roubini. They have this great big call, fantastic. They get one thing right, everyone starts following them, and then they get it. They're so-so for the next decade. It's often a matter of luck. So timing markets in a big picture sense can be really, really hard. Best thing to do is focus on the rolling 20-year return, which has been pretty steady and pretty good. And I should also note that the more you look at your investments, probably the more you're likely to be disappointed. You look at it all through the day, you can see volatility all over the place. It's 50-50 whether Alan Kohler is going to tell us the market was up today or down today. across markets. You can see there 54% on a daily basis, charts of the markets being up or down in the US or Australia. But if you look less, and I mentioned Alan Kohler there because he does that finance report that many people watch on the ABC each night, it's a greater chance of getting good news if you just look at once a month or once a year or even once a decade. Now, of course, you can't stretch it out that far, but I guess the key is try and turn down the noise, look less rather than more, although I know this is really difficult these days, and adopt a long-term strategy and try and stick to that. So I might leave it there. I think the next slide is scan me if you want to watch our Economist videos, but I will hand back to Nick and we can take questions.
No worries. Thank you very much for that, Shane, Deanna. Very insightful, as per usual. All right, we'll start with a hard-hitting question, so I'll let you guys pick who wants to answer. But context being US shares or US economy has had, been the prevailing or the main markets for decades now. So question is, with a lot of the political uncertainty, investors and possibly countries looking elsewhere, does this spell the end for US exceptionalism?
I'm actually debating this question with a robot at a conference later in August. So they're like prepping the robot at the moment. I've taken the point of view that US exceptionalism is going to continue. So I suppose in the short term, maybe not. It's easy to see in the next 12 months that US shares are not going to do as well relative to like Australia or Europe or emerging markets, although emerging markets haven't performed that well this year despite pretty good profit growth. And then I guess it depends what asset we're talking about. We're talking about the US dollar or shares or bonds. So I guess I'll focus on shares. I think that over the long term, the US still does have some of the best companies in the world. And if you're thinking about what's going to drive growth in the long term, it probably will be more of the AI story, not probably the companies that today we relate to AI like Nvidia or Meta or Amazon, but there might be new companies that benefit from it. And I do think that a lot of that still holds in the US. They have very strong productivity growth. They have a lot of investment into the sector, a lot of business incentives as well to outperform. So I'd say that over the long term, US outperformance is still likely to occur from a share market point of view. I do think that the US dollar is going to be on a longer term downtrend. And I think a lot of central banks don't necessarily want to hold as much USD as they once did. And I wrote a lot about that in the note that Shane referenced before.
Yeah, well, hopefully go on, Shane.
I was just going to say, for investors, you perhaps shouldn't worry about it too much. I know the media keeps beating it up as an issue, but you can probably end up obsessing about these things too much. If you go back through history, there's been periods where the US share market outperforms, or the US dollar has a long-term upswing, and then it goes through periods where it underperforms. And I think those longer-term secular swings will continue. You could argue, well, the US has been a star performer in recent years. Maybe it will have a decade where it will become a relative underperformer. Maybe Donald Trump's policies and uncertainty and the tariffs contribute to that. But in a big picture sense, it probably won't be that far out of the norm. I don't think, I reckon the US will remain as entrepreneurial as ever because of the nature of the way its economy is set up. But it can still go through these long periods of relative out and underperformance.
So if I paraphrase you, Shane, ignore the noise. Is that what we're hearing?
Turn down the noise. That's
yeah.
right.
All right, another one for Deanna then. So we've got a listener who scratching their heads a little bit in terms of the interest rate, the expectations regarding interest rates, given some of the comments that you both made regarding inflation and unemployment and economic growth, all sort of sitting within acceptable ranges, in particular with unemployment inflation. So begs the question, why do reserve banks and central banks around the world need to be cutting rates if we're in that ideal setting for those sort of factors?
Well, it's because growth is still pretty poor. So in Australia, GDP growth is running at 1.5% on a yearly basis or so, and we think it's going to start to trend back up to more around 2% in the next 6 to 9 months. But that's still pretty low for Australia. We have a population that's running at like 1.4, 1.5% on a yearly basis. So per person growth is flat to slightly negative at the moment. And that's not a good thing for living standards. Plus, interest rates are actually still restrictive. So when you think about we hiked rates to 4.35%, that was a restrictive level of interest rates. We were putting more downward pressure on the economy than upwards. We need to move that back into a more normal level. Given that rates went from 0.1 to 4.35%, we've only had 2 rate cuts, so 50 basis points. That's nothing in the scheme of how much we hiked rates. It's not necessary to take rates back to 0, I don't think. But even if the profile moves in line with our forecast, where rates get to just below 3%, you're still in a situation where rates were higher than where they were before the pandemic.
Yeah, okay, fair enough. So perhaps some more emphasis on the economic growth side of things. A question, a little bit of a left turn on this question. Shane, I'll direct this to you, given it's one of your favourite topics, Bitcoin. A question just regarding the increasing prevalence of Bitcoin, and it's been seen as a digital gold and a store of value. Do you foresee, does it have an impact on, I guess, the role that gold plays in the global economy going forward, given they're both theoretically meant to be acting as similar things? Is there any interaction there? Does one impact the other?
I think it does, and Bitcoin seems to be eking out a role for itself as a form of digital gold. It's not purely interchangeable because Bitcoin is still it's still it's more of a financial asset. Gold is a physical asset, so there's a difference in that sense. Bitcoin, you can move it around a lot easier. Arguably, it's probably going to be a lot more specky, but I think just as gold eked out a role for itself as a store of value over long term, because you could argue, and what does gold do? I mean, we used to use it as teeth. We do in teeth fillings and things. That's no longer the case. The only use it really has is as jewellery, but jewellery demand has hardly any impact on the gold price. So it's really just a store of value. People think it has value because it has value. And it's the same with Bitcoin. And so it's quite easy to do calculations, which we've seen multiple times, that if the Bitcoin space ekes out, just say, another 10% of the gold space, then it pushes Bitcoin's price up to, I don't know, 150,000 or whatever it was. I think we've done the calculation several times. And so I suspect that will happen. The other thing that's happening is that you've got a generation of people, maybe not my generation, but younger generation, who are a lot more comfortable with digital things, and that includes digital assets. So I might say, well, I would prefer gold because it's a physical thing and I can touch it and all that sort of stuff. And in reality, it is in people's superannuation funds as part of the commodity space. But my generation might be more sceptical of online stuff, of cyber or digital stuff, whereas younger generation is a lot more open to that and therefore has more faith in it, just as an older generation would have in gold. So therefore, you're going to have more people coming through over time who might think, well, maybe I should have some Bitcoin as a store of value in my portfolio. So I think to some degree, I've heard the saying that Bitcoin will eat gold's lunch. There's a bit of that going on. Some of the money that would have gone to gold on worries about the debasement of the value of the US dollar, the end of US exceptionalism, some of that money will go to Bitcoin, pushing Bitcoin price up over time. That's not to say that Bitcoin won't have these 4-year big corrections, Bitcoin winters. They're quite severe. Got to allow for that. That's probably still going to happen. Time will tell.
But aren't we due for one now?
Well,
we were last
year. You could
year.
argue that
and we never had it.
The last one was in 2022, was it? So yeah, there is a risk we could have one soon. But trying to time those things might be a little bit hard. But I think in the broader sense, over time, you'll probably see Bitcoin still benefiting from taking money away from gold. So that's why in a longer term sense, I think it still has plenty of potential, even though you're still going to get that volatility.
Gold has many. For example, my granddad used to have gold teeth, and that doesn't happen anymore. But he melted them down, and he made all his grandchildren necklaces out of them. So Bitcoin.
Well, that's only two teeth and jewelry.
I'm just saying, it's more value.
It does.
All right,
my granddad's teeth. Yeah.
We'll see if your granddad's teeth has an impact on the price of Bitcoin. But Shane, I'll give you a more traditional economist question. We've got a viewer who was, I guess, a little bit skeptical of the comment that you made previously, or it might have been Diana that made it previously, regarding that the team is of the view that the US will avoid a recession. Just questioning, given the fact that the first quarter was negative, and that with the April tariffs kicking in for the second quarter, surely that won't that have a negative effect that perhaps might outweigh any forward planning that companies did? Just maybe a little bit more comment, given we've had got the question coming through.
I think we both said something to that effect, but I guess we could pray. You know, the sorority girl there. There's a clip of her praying before she goes out, and this is Carolyn Levitt, Diana's hero. Mine is someone else, but she's praying, so maybe we can pray and then we won't have a recession. But in any case, I think we avoid recession mainly because the tariffs are not going to be severe enough to give us a recession. It's a risk. There's certainly a risk factor there. But don't forget, in America, I mean, the country most at risk here is the US. Imports are a relatively small share of the US economy. They're a bigger share in Australia. So if we did the same thing, or in some other countries did the same thing, you get a much bigger impact given the loss of purchasing power by consumers. But in the US, I think imports are only, 9% or 8% or something of their economy, much smaller than in Australia. So therefore, it is a drag, negative, but I don't think it's enough to cause a recession. Now, of course, it depends on how far Donald Trump takes the tariffs. When they're at 30% on that graph that Diana had, earlier this year after Liberation Day, or what I call Retro Day, when America wanted to go back to the 1950s. The risks were much higher back then. But then Trump realised, I think, that if he left them at that rate, it could cause a recession, and therefore he backed away. He also didn't like the thought of a bear market or a meltdown in the bond market. So I suspect ultimately Trump will, some would say, taco, chicken out. Trump always chickens out. Or alternatively, he'll find a way to say, well, it was all about negotiation in the first place. We've got these deals, and therefore we can have them at lower levels. So I think ultimately it settles at a level which is worrying for share markets and can give us a correction, but not enough to give us a recession or bear market. It's a risk, though. It's still a risk, but it's just not a base case.
No worries. We'll probably finish up with maybe one more question each. So, Diana, I'll start with you. Just picking up there the comments just regarding tariffs. Tariffs have been in place since April, albeit at a lower rate at the 10% rather than the previously threatened rate. But we're not really seeing that flow through into inflation. Any comment as to why we're not seeing it, whether that changes expectations, we might see it a little bit later on, or just any sort of general comment there?
Well, some of the tariffs actually started a bit earlier than that, than April, like the steel and aluminium tariffs, which started, I think, in February. And we have a whole timeline on these things. It's hard to keep on top of in your brain. You have to write it down. It looks like some of the pass-through has been absorbed by businesses themselves, so it's gone into business margins. The import data that we get from the US actually doesn't include any customs impact, so we can't actually see any direct import inflation into there. I think the majority of the reason is that it's really just a lagged effect. If you look at that effective US tariff rate chart that I had in the slide pack, you can see that rate only has gone to that 9% level more recently. So I think that the latest data is up to May, perhaps early June. That data is available daily, so it's like a rolling sum. So given that we haven't had the June CPI figures, I think we're going to start getting more of an impact from the tariffs onto consumer inflation. But there has been some impact to businesses absorbing the cost themselves. I guess just hasn't been as severe. And I did see that Trump tweeted on Truth Social, he posted last night saying some of his economists have calculated that tariffs have no impact to inflation at all. So people are going to debate this. The Republicans are going to say that there's no inflation impact, and they'll point to what happened with Trump 1.0 in 2018, where there was quite a minimal impact to inflation at the time. It was a different economy, and then it was impacted by COVID. So we didn't have that long to wait for the data. I do think that we are going to see the impact to consumer prices soon. But the question is it going to be a big lift to prices? I think it's probably going to be a bit more moderate.
Yeah, okay. So maybe just still a bit more of watch this space.
Yeah.
And then the final question, Shane, so you're obviously very famous with the saying in terms of turn down the noise. So just a comment or a question in terms of, looking to the long term, that's fine and works for those that have the long term, the ability and the timelines. But just a comment on those that perhaps don't, that are coming up to retirement or that are currently in their retirement and therefore can't ride through those market cycles. Just in terms of, I guess, current market, where markets are at, and maybe that just as a general comment for those that don't have the same timelines in mind.
Yeah, that's true. And as I get older, I've got to become more conscious of that as well. And you think about best ways to manage that. I mean, financial planners out there listening to this will say, well, we've thought about those sorts of things. And one approach is you always make sure you've got enough money sitting in cash. So you won't necessarily have as much money invested in markets as you would when you're working full time or you've got 20 years to go. But it still depends on your wealth level, I think, ultimately. But the best advice I could say is, well, if you are worried about the short term, make sure you've always got plenty sitting in cash to cover a couple of years' worth of expenses. Or you go down the path of getting funds which pay pensions. We're actually doing quite a lot of that at AMP these days, to looking at those things that pay you an income stream through time. But then you still have a bias to growth assets on the grounds that, if you retire, say, at 65 or 67 or something, you still might have 15, 20 years of good living ahead. And therefore you want that to last through that period. So therefore you'd still have some growth assets in there. But I think the key is to make sure that if markets do have a downswing, you're not in a position where you have to take your money out of the market. Obviously, someone who's working doesn't have to. They're still getting the income. But if you're a retiree, you don't want to have to take your money out of the market. So that's why you want to have that cash sitting aside or something that pays you an income stream through time. So, yes, we spend a lot of time looking about where markets might go in the short term. What are the risks? Right now, I still feel more nervous about things given these issues and uncertainties about Donald Trump and valuations. But I also know that it is really, really hard to time that. So, at times I feel more nervous about things and other times less so. And we try and reflect that in our funds, working with Stuart Elliott and the PMs on that front. But I think for many investors, trying to get that timing right is going to be really, really hard. Fund managers try and do it, and even there, you get it right some of the time, but you're only got a 60% winning rate. For individual investors, it gets really, really hard. So you're still better off sticking to a longer term strategy. It's just that it might have some more sitting in cash or a guaranteed income stream over time than you would when you're in the pre-retirement phase.
Yeah, and I guess that's why we've got the life cycle evolution within our superannuations offering, so
that's right.
To accommodate for those sorts of things. But like I said, I'll leave that. We've run slightly over time, so we'll leave it at that. But thank you very much, Shane and Diana, for your time, and thank you very much for everyone joining us. Like I mentioned at the start, there is actually a lot of things happening with AMP. We're coming out with some really interesting things. So if you wanted to know more about it, please reach out to us. But I'll just say thank you very much for everyone for your time, and hopefully we'll see you again next time. Thank you very much.
Thanks, Nick. Thanks, everyone.